Stop right now because silver just did something that most people will explain the wrong way. And if you own even a little bit of it, this matters. In the last stretch, silver surged hard, then snapped back with violent whipsaws. Not a gentle pullback, not a normal red day. The kind of move that makes confident people suddenly doubt themselves and makes cautious people suddenly chase. So what exactly happened? Silver entered a high volatility momentum phase. Why this move matters if you own silver, where 8 to 10% swings can show up fast. And the market is starting to behave like it's preparing for a breakout attempt through the $100 psychological line, with a hot zone target near $16 sitting above it like a magnet. But here's the twist. The same volatility that can launch the next leg up is also the weapon that wipes out late buyers and over-leveraged traders. And if you don't understand the mechanics behind the smashes and shakeouts, you'll get shaken out right before the move you waited for. So in this video, I'm going to walk you through the real forces driving this action. What levels matter next, why the recent sell-offs are often mechanical, what gold is quietly signaling, and why miners are lagging in a way that could actually be bullish. And at the end, I'll give you the one volatility surge, the real driver behind sharp swings rule that keeps you from turning a winning fees into a painful round trip. Quickly, this is John AG, and I need your support for something important. I'm running a campaign to eliminate copycat channels that steal, repackage, and repost content like it's theirs. If you value original work, subscribe right now and comment OG John AG so I can recognize the real supporters. That single comment helps me push harder and clean up the space. Also, because I want to stay close to the real audience, I created a WhatsApp channel. Daily updates, quick notes, links to daily videos, and sometimes my personal experience and what I'm watching in real time. The link is in the description. Join it so you're not reacting late. Now let's get to the market. Silver isn't leading because it's fun. Silver is leading because capital is rotating out of stalled places and into moving ones. When equities chop sideways for months, money looks for a new home. And right now, metals have the momentum. You can see it in the way attention has shifted. Silver, copper, resource names, miners, all creeping up the priority list. Not because the news got prettier, but because the flow changed. And silver is a special case because it's small. The $100 level. Why psychology matters. When big pools of money lean into a small market, price doesn't crawl, it lunges. That's why silver can look boring for weeks and then suddenly feel like a rocket. But rockets shake. When you see repeated 10% days back and forth, it's not random. It usually signals crowding. Big buying meets big selling. Positioning gets heavy. And heavy positioning means the next move tends to be bigger than people expect. Now, everyone wants the same answer. Are we going to $100? Here's how I think about it. $100 is not magic, but humans are. Round numbers flip psychology. $99 feels like a chart. $100 feels like history. And when a market approaches a round number during a momentum phase, you often get one of two stories. Story one, the market punches through, triggers a wave of headlines, and the late crowd floods in. That can fuel a fast extension higher. Story two, the market teases the breakout, then rips lower in a brutal shakeout because that's exactly how you create maximum major upside zone. What the market is watching next? Pain. You scare out holders, you trap chasers, and you reset leverage. Both stories are possible. That's why the real skill is not predicting, it's preparing. Now let's talk about the $106 area. I'm not telling you it will happen. I'm telling you why it matters. Markets like magnets. Targets become magnets because traders front or run them, algorithms react to them, and social media turns them into a scoreboard. Even if price never settles there, it can spike toward it and reverse so fast that your brain can't keep up. So if you're watching silver and imagining a clean, straight ride, forget that idea. The ride will be messy. The payoff, if it comes with chaos. And this is where the biggest misunderstanding shows up. Every time silver dumps hard, people scream manipulation. Sometimes markets are unfair, sure, but a cleaner explanation for many of these sharp pullbacks is mechanical margin. When volatility rises, exchanges and brokers often increase margin requirements. That means anyone using leverage suddenly needs more cash to keep positions open. If they don't have it, they sell. Not because they changed their mind, because the system demanded collateral. And here's the part most people miss. The people leveraged in silver are often gold signal, and why it affects silver leveraged across the complex. If you're long silver, you might also be long gold, platinum, miners, resource equities. So when margin rises, forced selling spreads, it hits the whole basket. That's why you see ugly candles that feel like an attack followed by recoveries that feel like nothing happened. The move wasn't a new narrative, it was plumbing. This is also why being right about direction isn't enough. If your position is too big or too leveraged, a mechanical dump can remove you from the trade before the trend resumes. Now, while silver is stealing the spotlight, gold is doing something important in the background. Gold has been acting more like a staircase than a firework. Rally, pause, rally, pause. That rhythm matters because sustained bull markets often advance in waves. You don't get a straight line, you get legs. Many traders are watching a zone around $500 to $5,200 as the next major area of interest. Not a prophecy, an area, a place where price might react. What I want you to notice is the structure. Higher highs, higher lows, moving averages sloping up, and pullbacks that look news-driven rather than trend-breaking. And here's the mindset shift that changes everything. Gold. Why miners lag and what that can mean isn't expensive. Currency is weaker. Gold is the measuring stick. The stick didn't change. The units you used to measure with it did. When it takes more dollars to buy the same ounce, that's a purchasing power story. That's why people who treat metals as long-term insurance don't obsess over perfect entries. They obsess over staying solvent and staying positioned. But in the short term, yes, you still respect dips. You still respect volatility. You still avoid chasing. Now let's talk miners, because miners are where people get confused. Before we go deeper, let me answer the two most common messages I've been getting this week. The first one is, if silver is so strong, why does it feel like it's trying to throw me off every other day? Because the market's job is not to make you comfortable. The market's job is to move price to a level where it can find the next buyer. And in fast phases, it finds buyers by creating fear, then relief, then fear again. It's emotional conditioning. The second message is, should I be in physical metal or should I be in paper exposure? Here's my take. Physical is for people who want ownership without someone else's promise attached to it. It's slower, calmer, and it's not designed for rapid flipping. Paper exposure is for people who want liquidity and quick execution, but it comes with rules, margin changes, and counterparty layers that can matter at the worst time. So, the shakeout pattern that traps most traders, whichever you choose, match it to your personality. If you can't sleep when price moves, don't use leverage. If you can't control impulses, don't chase breakouts. If you want to build long-term protection, think in years, not in Tuesdays. Now let me add one more piece of context that almost nobody talks about during parabolic runs. A lot of traders treat volatility as a signal to add more size because they think big moves mean big opportunity, and sometimes that's true. But big moves also mean your risk expands. Your stop has to widen, your dollar swings get bigger, and suddenly what looked like a small position becomes something that controls your mood. So, if you want to survive what's coming, you size down before you size up. You earn the right to add. You don't demand it. And keep this in mind, when silver finally hits the headlines again, you're going to see non-stop stories about how it's overheated, how it's time to take profits, and how the top is in. Just like every other cycle, the loudest voices will show up at the most emotionally extreme moment. That's why I want you focused on structure instead of noise. Is the market still making higher lows? Are pullbacks being bought? Are the sell-offs happening on margin events and then recovering? Those are the tells. Okay, back to miners. If metals are ripping, why aren't miners flying the same way? Because miners are businesses, not bars. Miners have cost structures, political risk, operational risk, energy risk, management risk, and miners trade inside the equity ecosystem. Physical metal can become a global safety valve. Miners can still get sold like stocks during risk-off moments. So minor risk rules for high volatility markets underperformance doesn't automatically mean the metal move is fake. Sometimes it means big money prefers the clean exposure first, the metal itself. And sometimes it means the market is worried about margins. Energy costs matter. Inputs matter. A rising oil environment can pressure miners even as metal prices rise. That's why miners don't behave like automatic leverage. Sometimes they amplify, sometimes they disappoint. Now, if you look at miner charts, you often see a pattern that is designed to break your confidence. A common one is the ABC correction. First drop, then bounce, then a final flush that slightly undercuts the prior low. That last flush is the shakeout. It triggers stops. It convinces people the move is over, then it turns and runs. That's why tight stops in a volatile bull market can be a liability. You think you're being safe, but you're placing your exit exactly where the market hunts. So what do? You keep your process simple. You don't become a fortune teller. You become a risk manager. You ask, is the trend intact? Is structure holding? Are pullbacks mechanical? Are flows still rotating? Are buyers stepping in on weakness? Now, I want to bring this back to silver because this is the core. Silver is in the zone where a single strong push can carry it through $100 and ignite the crowd. And if that happens, the next upside magnet sits above and price can move faster than logic. But if that push fails, the market can still do a savage dump first and then make the real move after it humiliates everyone. This is why the next phase is not about being bullish. It's about being prepared for whiplash. What to watch next? Signals that matter. Here are the two biggest ways people lose money in the best bull markets. One, they chase the breakout with emotion, size up too much, and then get shaken out on the first violent pullback. Two, they hold a good position, see a big profit, get greedy, refuse to plan exits, and then watch gains evaporate because parabolic moves reverse violently. So the goal is not to guess the peak. The goal is to build a plan that survives both outcomes. If silver spikes, you already know what you'll do. If silver dumps, you already know what you'll do. You don't decide in the moment because the moment is designed to trick you. Now, I want you to do two things for me in the comments because it helps me shape what I cover next. First question, do you think silver touches $100 cleanly, or do you think it fakes everyone out with a brutal shakeout first? Second question, are you stacking physical, or are you trading paper exposure like ETFs, options, or futures? Drop your answers below. And one more thing, if you're successful in any way, whether it's business, investing, career growth, a side hustle, anything that changed your final takeaway plus your next step life, share a quick line in the comments. People need real examples. Your story can raise someone else's confidence today. Now, quick creative detour because some of you keep asking for more inspiration content. If you want silver-related success stories, real stories of people building wealth, learning lessons, and doing it step by step, there's another channel linked in the description. If that's your vibe, subscribe to that one too, and binge the stories. It's a different style, but it's powerful. Back to the heat. The reason this moment feels unreal is because silver is a tiny market relative to global capital. When global demand turns on, there isn't much room. The price adjusts fast, and that speed changes behavior. People start checking charts all day. People start refreshing. People start doom scrolling. People start bragging. People start panicking. And that's when you stop trading silver and start trading your nervous system. So here's the rule I promised at the start. In parabolic phases, you do not get paid for certainty. You get paid for process. Process means position sizing you can hold through swings, exposure that fits your life, a plan for volatility, and a willingness to let the market prove the next step. If you're not in yet and you feel FOMO, don't chase. Markets usually offer entries through dips, consolidations, and shakeouts. Patience is the admission ticket. If you are in, don't let volatility bully you into impulsive decisions. Respect the swings, but don't surrender your plan. And here's something to watch over the next few sessions. If you see silver dip hard and then snap back quickly, that's a sign demand is waiting under the market. But if you see silver rally and then stall for multiple days right under a key level, that's the market loading the spring. Both setups can lead to a breakout, but the path will look different. So don't just stare at the price. Watch the reaction. Watch how fast buyers respond. Watch whether sell-offs get erased or whether they linger. That reaction speed is often the real signal. And remember, if you want me to cover specific silver setups, minor setups, or even risk management examples, tell me in the comments what you're holding and what time frame you care about. I'll pick a few comments, break them down, and turn them into the next video. Now, we're getting close to the end, and this is where I need to be blunt. My stats show a weird reality. A lot of people watch, a lot of people benefit, and most still don't subscribe. If this content helps you support the work, subscribe now. It's one click. And if you want to back the campaign against copycats, comment OG John AG so I can see you. That's your badge. Also, don't forget the WhatsApp channel. The link is in the description. Join it because daily updates keep you ahead of the emotional crowd. Now here's the final cliffhanger. If silver truly is entering that euphoric zone, the biggest updates may arrive clustered together, fast, chaotic, and impossible to time. And the people who win won't be the loudest. They'll be the calmest because they'll already know that volatility isn't a sign of panic. It's the price of admission. So tell me, do you think silver breaks $100 first, or does it punish everyone with one more shakeout? Subscribe. Comment OG John AG.